The recording has started.
All right. Good evening, everybody. This is Jim Brown, Chairman of the Board of Finance, and welcome to our virtual quarterly review meeting, Tuesday, May 19th. We'll call this meeting to order. Can we please stand for the Pledge of Allegiance? I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Okay, well, welcome back, everybody. If it seems like we just met, that's because we did last week. And so I actually thought this quarterly meeting was next week, but here we are. So for the public, if you call to listen, you will not be heard by the board members and there will be no live public comment. The public is encouraged to send their comments before or after the meeting to the following email, bof@fairfieldct.org. So we have a typical quarterly review meeting agenda ahead of us. We will review the current status of the town's pension and OPEB funds, and we will keep the discussion to the documents before us. Then we'll go to the Board of Ed, Quarter 3, financial position, the town's Quarter 3, fiscal 20 financial position. And then we have multiple minutes that we will approve, and that will be our night. So let's start. Mr. Vahey is with us. Brian, welcome. And Mr. Brackfeld is logging on as we speak, and we welcome him too. So Brian, at this point, I'll turn the meeting over to you.
Thank you, Mr. Chairman. Everybody hear me? We
can hear you fine.
Great. Now, if I just don't strain my eyes trying to look at the the documents you're looking at. So we'll start off this conversation with saying things changed markedly from February to the month of March. I believe the last time we presented was Mr. Brockfeld, who told you we were transitioning to a new outsourced chief investment officer firm, and that's a new structure for us as well. We never have had an outsourced chief investment officer. So I won't belabor that, but I wanted to let the body know that we intend to invite them to the next quarterly review so that, and probably to all future ones since they're joint fiduciaries, which is a new thing, and it's important you guys meet them. And then as far as the markets, I'm speaking equity broadly here, were up going into February, even as things were going on elsewhere in the world with regards to coronavirus. And then we had, I believe, one of the worst Marches on record going back to the Great Recession, or actually Great Depression, excuse me. Is Ken on yet? Yeah. So in the month, we saw equity returns down 30-something%. I'm speaking to the S&P 500. We luckily are not overweight equities as a whole. We're actually underweight equities going into it just slightly, but that I can't say that we planned that. It just sometimes you get a little lucky, and we had raised cash for actual payments right before the markets turned down, and we took them. We took the cash ins out of the equity funds. So you can see before you, I'm referring to the main pension document, which has, so page 1, at the end of March, we sat at 351 million, down from 389 million. So it's a decline, as you can see on page 3 of about 10%, which is in line with, we didn't outperform anybody in regards to most pension plans. We did have less equity risk, which helped a little bit compared to some other headlines you might have seen. And now I'll also point out that the month of April and so far in March, stunning rebounds. Matter of fact, I think the month of April was one of the best 1 month periods. Also going back in recent history, we saw a bounce of more than 17% in the S&P 500. So down 30 something, up 17. And so far this month, although I don't have today's numbers in, up another 10%. So believe it or not, the S&P sits from a 1 year perspective about where it was. So we're about flat on the S&P 500 if you went back 1 year. And people get a little confused because their perspective is skewed by how high the market got towards December of last year. It was an insane rally of like up 17% in the last 3 months. And so that's where their focal point is. They don't know where the market was last July 1st, but I can tell you it was right about where it is now. There's Mr. Brackfeld.
I am sorry. Do you guys hear me?
We can hear you, Ken. Welcome.
Thank you. And I sincerely apologize. I had a little bit of a issue, but I'm here. Thank you, Jim.
And Ken, I was just going through sort of a macro picture on the equity side and actually including last month and portion to date. And then on the fixed income side, which I think is also important, and it's actually reflected in these numbers, we saw the 10-year Treasury go from around a 1.6% down to currently, I think today it was like 0.7%, which is about it's 100. It is not about. It's 100 basis points lower, which causes your fixed income portfolio generally to go up in value, which we did see in our Sykes and a bit in PIMCO, but PIMCO is global and not all markets behaved like the U.S. market in the fixed income space. So I want to point out, so I would say in general, the fund performed, as a diversified fund, it performed as expected. So the pieces, except for one thing, which we'll get to, but if you look at all the individual pieces, fixed income was a buffer, thank heavens. I don't know how much buffer is left when interest rates are this low. So the equity markets to turn again, obviously we don't have another 100 basis points left in the Treasury market, well, unless we go negative. Hedge funds were about flat, which was great. Our absolute return Invesco fund was also about flat. Real estate, these numbers are lagged, but we reached out to get more color on their exposure to retail and multifamily and hotel, because obviously those sectors have been severely impacted. Luckily, it's an actively managed portfolio. They have very little exposure to those sectors. They're overweight more multifamily, so in the rental space and office. And another positive was that we had disruptions in the market with regards to financing until the Fed stepped in. But that principal real estate manager had dialed back their leverage last year, just being prudent, and that served them extremely well. Private equity, we've not gotten the most recent numbers. They're not putting out any, typical. I would say if they were having issues with valuations, we would get some notices. They're essentially saying that they expect some drawdown in value, but not. Well, based on what they've sent out, we not expect to see any kind of giant moves out of our Lexington exposure, and I have not seen anything from Mesero. So those numbers are lagged. But I will say generally, private equity as a whole got hit in some cases very hard. but we don't invest in the types of private equity that were getting hard, which is larger buyout funds. We're more middle market, restructuring, some buyout, but they don't have the same amount of debt and leverage. And it's because that's just, we like that performance profile and the risk profile, and it's served us well in downturns in the past, and it looks like, knock on wood, hopefully it will this time as well. Commodities, all I can say is they've outperformed over the long term, that particular manager to the index, but commodities have not been a great thing to be in. And maybe this body, I don't know if Mr. Walsh is on, Vanguard as our new OCIO, they believe we can get inflation diversity hedges from something other than commodities. So we probably will not have commodities to talk about in the near future. So I want to get to the last, if you go back to the equity exposure, you'll see one of our large cap managers, Allianz, which is the insurance company, and their subsidiary, the asset manager, Structured Alpha, which is an S&P 500 fund that attempts to add value from an active perspective by using an option overlay. They performed absolutely miserably during the crisis, and were delayed in reporting that the true numbers for a while, and then and gave us, and I say us, all investors, an explanation that wasn't up to what we would expect, and also wasn't up to what Callan, as our advisor, would expect. And it was about a $1.something billion fund. So there are a lot of large institutional investors who also, I'm sure, were left with more questions than answers on that performance. What we did subsequently to this is we, obviously, Callan and ourselves got together to discuss what was put out by Allianz, and then what we should do, whether we should stay in to the investment or whether we should exit it. And we decided to exit it. I've gotten our money back, and it is Caitlin on here? Caitlin, did the reinvestment into the Russell ETF happen already? I don't know.
Yes.
Actually,
just
before
today,
yesterday. Okay, that's great. It's not. I'm just. We missed yesterday's giant move then, but that's just timing. But as good, it's back in the market. So it's back for the board's information. It's back in the BlackRock Russell 1000 index. So we did all that, and the reasoning behind terminating the investment was multiple fold. One, it was the lack of clarity on what they provided to all the investors, and the fact that this particular fund, one of the reasons we invested in it is that their compensation scheme is they only are paid if they provide a return above the index, which was a big part of why we would consider to have an active manager in the large cap space, because our experience and why the rest of the money is in passive is because there's not many managers that can provide that in the traditional stock picking space. So the fact that they don't get paid unless they outperform, and they're down that much, they wouldn't be back to earning a management fee for till they regained all those losses and actually started outperforming the index. And we felt that they would potentially lose a large portion of their team who have their own money in the fund, and with that compensation structures kind of see a bleak outlook. So there's plenty of reasons to get out, and so that's what we did. And I will just leave one further thing is that we are further exploring our options with regards to that investment, meaning it's an SEC registered advisor, large institutional offering. They have marketing materials, and they have made presentations to us that over a 2-month period back when we originally invested a little over 2 years ago. And I'll just say that even after reviewing how they performed in 2008, which was it was worse than the index, but just slightly, that this performance based on their investment strategy just doesn't line up. And so we're looking into, possible remedies, and I'll leave it at that. Ken, is there any other stuff that I'm leaving off about the portfolio?
No, actually, I think that was excellent overview. I came in a bit late, so I apologize. The only thing I would say is that, we're prepared to answer any questions, and I think the Allianz thing, I'm sure you guys have some questions, but I do think that one thing everybody should pay close attention to is the benefits of a diversified portfolio, because we've gone through a unbelievably stressful time in the marketplace. And if you leave aside nitpicking one thing or another, and you take a look at the global picture of our pension fund, you do see the benefits. For example, we have a big allocation, as Brian said, to high quality investment grade fixed income products, right? So, there's a yin and a yang in these markets. And while some things have done poorly, other things have done their job, so to speak. I think the other thing I would just observe going forward, and Brian touched on this as well, and I have a background in fixed income, that's my career. What I find fascinating is that the 10-year Treasury has remained down at the yield level that Brian described, I think, which is about less than 1%, right? Like almost 0.5%, 0.60. And that's after we've had one of the biggest up moves in the stock market in history, which really raises interesting questions about whether or not going forward the relationships between different markets are necessarily going to hold. So I will tell you that as a board, we have a very challenging road ahead of us because not everything we've always expected is necessarily happening. But again, I just want to emphasize a diversified portfolio is a must. And if ever there was evidence that that makes sense, this has proved it.
Thank you.
Just one other thing that I left out, just one tag onto that is not only did the fixed income markets not react to this rally, but gold also rallied, which should be disturbing. But I usually go over sort of weightings. So as of this snapshot, you can see weightings are skewed down because of the massive equity move downward, which caused everything else to float up. We also took more money out during this period because the markets, we had some lockups in the commercial paper market and in portions of the fixed income credit market and the high yield space to a disturbing level, meaning that's why the Fed stepped in and provided liquidity like we've never seen before. But so while that was going on, we actually contacted the overweight you see here from Sykes, who are in New Jersey, and one of our fixed income managers, and I believe, put in a request for $6 million. And Caitlin, did they eventually take the $6 million out, or they only took out what eventually occurred? I know we were eyeing up $6 million, but they said that they had plenty of liquidity and we only needed 2 and change for payments. Did they liquidate more, or did it?
Well, they took out for the May payments about 2.5, and then they just took out the June ones for another 2 or so.
Yeah, but I think they were, and they parked. You're right, and you told me they parked that also in their in-house sort of money market, short-term funds. So well, what that did was it knocked down some of that overweight and mismatch. And then, of course, the rally that's just occurred in April and the beginning of this month. I don't have the final month end in front of me yet, but I can tell you that the fund is, it's probably down 2.5% to 3% fiscal year to date, and our weightings are amazingly enough kind of back in line with their targets. So it's just been a bizarre market move, and my final comment would be, as Ken said, I'm not going to look a gift horse in the eye, but and I too admire the way a diversified portfolio managed to get through all that. I just don't think that we can say, who knows, can't predict the future, but I would say that it's rather remarkable that we're back sort of to where we were, and by any metric, markets were way overheated before we went into this. And given the way the world looks in the next 12 to 18 months, the math doesn't seem to work for me. But then again, I've never seen central banks do what they're doing. So maybe I'm wrong, and it's all going to be great. So I'll just leave it at that and open it up for questions.
Mr. Vahey, I'm going to, Ms. Charles Nestor, she had her hand up first, but did you just say maybe you're wrong and things will be great, which means you think things will be the opposite of great?
So Mr. Brackfeld said he's got his background in fixed income, and that's how I grew up as well. I grew up with GE Capital and lending and fixed income, and the whole premise of getting your money back and believing that equities is more speculative than anything else. So yeah, we're pessimists by nature, and I think that's a good thing for trying to preserve wealth in a portfolio. We're always that should be your first question all the time. Is I think is prudent investing and diversification and trying to get money back. So yeah, I don't know. We do a survey of our body, and we'll be Callan is gone, but they are cautious. I still get their pieces, and Vanguard, they preach a good message, which is stay the course. And we certainly are. We did not, we're not planning to change from a diversified setup, because we don't make tactical short-term decisions, and there is no other magic panacea for navigating turbulent markets. You try and spread your bets and keep stuff with different correlations, and just that's what's worked over the past 60 years, and let's just hope it keeps going. Although Mr. Brackfeld did say that the markets are not moving the way they're supposed to, so we should have seen, when the equities went up, we should have seen some sell-off in the bonds, and certainly should not have seen gold rally. So whatever, we'll just keep we keep our eyes on it.
I can also add on a few thoughts, Jim. Two that come to my mind. One is that, ironically, the level of nervousness that Brian's describing, which I, by the way, share as well. I'm actually just, anybody who could say that the world today is basically as good as it was, say, 8 months ago, just doesn't feel right. So I'm just looking at the level of the markets from, say, 6 or 8 months ago, which is where we are now. But when you have so many people nervous and bearish, that in of itself can drive the markets up, because you have a lot of cash waiting on the sidelines to be spent. So I think all I'm doing is agreeing with Brian very strongly that it's not the job of a pension fund like ours to try and game the markets and make these kind of predictions, because over the type of time frame we're talking about, 10 years, 20 years, 30 years, 40 years, 50 years, hopefully all that stuff comes out in the wash, right? And we should have the staying power as a community to to get through that. So I don't think I'm saying anything different than Brian, but just amplify it.
Yeah,
Thank you, Ken.
and I would also say we are going to go through a technical recession, meaning there's just no avoiding it, which is two consecutive quarters of GDP that are going to be negative. I mean, it's baked in. It has to happen. And the odd thing is markets usually anticipate that. So equity markets usually turn down about 45 days before, and the bond markets signal it way before. So remember, we had a yield curve inversion about, gosh, it seems forever ago, but I want to say that was 14 months ago. I think it was February, March of last year. And that usually signals bad things, but not immediately. And so that could have been the start of a natural recession, and things were turning over without the coronavirus. So in that regard, I would say also that we're in a technical recession and an actual kind of consumer recession. So we're going to see defaults and bankruptcies, which you read about in the paper every day. JCPenney, I guess I could rattle off a bunch of names right now. So should create some opportunities and some flushing out of the markets. And so I'm a little perplexed because mortgage delinquencies and stuff are going to go up, and it's going to cause some pain for some banks and stuff. So we'll just see how our managers handle it, particularly in the small cap space and fixed income managers. And actually our private equity market guys, if they do have a lot of dry powder to invest. And so hopefully they take this opportunity to maybe participate in some of the distressed workouts. And so try and put a rosier spin on things.
Yeah, let's see what the other members, any questions from the other members?
Yes, Ms. Charlton.
Thank you, Mr. Chairman. Hi, Brian. Hi, Ken.
Hey.
So just to clarify, on the Allianz, we are fully out of that position, correct?
Yes, there was it's a monthly liquidity vehicle, a separately managed account. So that's pretty typical.
Okay.
Not a mutual fund with daily liquidity.
Right. So when were we out? At the end of March, April?
Requests were due by April 7th. We met on March 20. Forget when the date of the fourth Wednesday in March. We got our request in before the date of April 7th. And Caitlin, I forget when the cash came out, but it was pretty quickly.
Okay. So what was and if you said this, I apologize, I missed it. What was the amount of the realized loss on that position?
On here, so we got about an extra, it was 18, right, Caitlin? The 18 that we got back, right?
Yeah, 18.2.
Yeah.
So yeah, on here it reflects 16 something. So we got part of the equity rally up until April 7th, when they processed our losses. So the total decline was from roughly 31 million to 18. So 13 million on 13 out of 30. So 30, I can tell you exactly if you want to have some other.
So
Do you have any other questions?
Yeah, so roughly the realized loss was roughly 13 million. Okay. And just, can you, and I apologize if you've taken the board through this before. This is, I don't know if it's my first time, but I don't remember talking about this one. The fund, the strategy of this fund, right? It looks like the benchmark is the S&P 500, but just the name of it, alpha So where does the alpha come from? You mentioned something about an option overlay. Were they writing options, buying options? What was that a big part of the strategy, those types of derivatives, or is that what triggered the loss, or the kind of the differential from the market performance?
Okay, so I'll try and watch for delayed dives.
Just briefly, I'm trying to, understand what drove the, the negative alpha, I guess, from the market.
There's two types of, in the institutional market, where it's not some kind of crazy speculative hedge fund environment, there's large pensions look to the options market for two things: potential alpha and we'll call it tail end hedging, so significant bad thing hedging. And oddly enough, this fund was supposed to provide a little bit of both, and it did provide alpha for the little bit over 2 years that we were in it, and it had a 12+ year track record going in, but they're one of about 35 funds that operate in this space. And many big shops have a version of this. So AQR down in Greenwich is a massive player in this space. PIMCO runs a significant one, but they generally call them, and there's actually indices. So you can actually do this through ETFs, although we don't trade individual positions, but I guess we could ask a manager to do it. But there's a thing called a put-right index and a P-put index, which is the P-put is essentially buying way out of the money puts, and you can keep rolling it over, and it provides you sort of a hedge. And the P-right is they write puts, and when you say you write a put, you're selling it, and so you're short, and you get the premium from doing so. What Allianz does, it's a little bit different than the other funds that were out there, and one of the reasons that they were attractive, and I don't want to speak for Callan, but they were on Callan's approved list and lots of their clients, and so did NEPC. So New England Pension Consulting is another large consultant for pensions that also had several clients in the Allianz strategy. Is they combine the strategy, so they use calls and puts, and they also do way out of the money put strategy. And then the underlying is either ETF or futures on the S&P 500. So they use minimal leverage, and they use a corridor of options to generate alpha and spend some on options to provide protection. It worked all the way through, the 2000. Oh, and they don't trade, which is different. Many of the names I already gave, they actively are in trading stuff, and that's not horrible necessarily, but it adds another dimension of potential risk. And Allianz is more of a model driven, and they buy and hold, so they don't get stuck not being able to move out of positions when the world's blowing up like it just did. What they claim is that somehow their out of the money put protection, which is supposed to give a buffer to the portfolio, was not structured in such a way to deal with consecutive 7 and where we lost 5% and 7%. Anyway, there's a very sawtooth pattern down on the 31% decline in a span of 12 trading days. But they consistently said that they hold 1.8 times the amount of protection that they do on the exposure to being writing puts, so the sort of their short position versus their long. And that's probably some version of what all the other competitors do, and some of them are active, so they trade the space more. They're trading it as it's going on. I will say the index and all the other competitors mostly held up fine, with the exception of you probably read about the Canadian pension fund that lost an awful lot of money. They were doing that in-house, so it wasn't something that we could have participated in, but they appeared to have gotten something wrong as well. But I know it's really complicated, but it's essentially they're creating alpha, like you said, from getting income off of options. And I tell people that, why can that possibly work, or what's the rationale, or why do these guys exist? Like we said, the large cap equity space and also other portions of the equity markets are very efficient. And it's just extremely hard for an active manager to charge any kind of fee and deliver performance net of that fee. The options market is, it's got, academic, statistical, observable, historical discrepancy. It's not efficient. And so that provides the ability to extract value on a consistent basis and provide it. And that's why these 30 or so funds exist and implement these strategies. And the logic says that as it gets more and more populated, more people do it, that maybe that inefficiency will be driven out too. But in the past 15 years or so, it's provided not huge returns, but it's provided about 0 to 150 basis points for the non-exotic sort of strategies.
So have they, it's not clear, I guess, maybe we're not clear why their strategy didn't work. I can't really tell from you said if they were a net buyer or a net writer of put options, but they, obviously it did not buffer their portfolio. It created losses. Is there any, and maybe you can't answer this right now, I think you said you were going to look for, determine if there were perhaps, remedies, but is there anything, I know we're one of a number of institutional investors in this thing. Is there anything that would make us believe that this was something other than an investment strategy that went bad, versus, fraud or a lack of disclosure or anything like that? I mean, is there any, anything out there, any rumblings out there? Because if there are remedies, clearly we wouldn't go at it alone, right? There would probably be multiple investors that would pursue the same.
So I will say that this strategy at Allianz and this methodology, they actually had several flavors, offerings. They had some attached to fixed income. They had some that just stood alone, so it wasn't attached. There was no index exposure, so you could just purchase it and put it in your portfolio and get alpha. And then they had some versions that used more margin, more leverage to execute, and it was, one of them was called the Structured 1000, which a lot of their own employees were in. Unfortunately, that fund actually closed. It was down 92%.
Just on liquidate?
Yeah, done. That was, so the call that all investors were on was for all the strategies. So we had people that were in that offering, and then folks like ourselves that were in the Structured Alpha 250. There are definitely lawsuits emanating out of Chicago, White and Co., I think. I don't know much more than that, but that there's a solicitation for investors that were in there. And once again, there's no claim filed. And I also know, unfortunately, that somehow a couple of the brokerage houses, this was offered to retail investors. I don't know if they were high net worth or whatnot. So there's 2 FINRA filings, arbitration filings, because they can't use class action. And so those, I don't want to misspeak, but I think it was Merrill Lynch and UBS. So, and I don't know what nature that's going to take. I did read what the basic genesis is, and their first avenue of attack is going to be that it wasn't appropriate for a retail investor to understand this and be offered this. But sometimes in those other facts turn up, so we'll see. I do want to point out to the board that we have a process a lengthy process when we go into new investments that I honestly, it's always been present in my 10 years, but it's gotten pretty advanced and nuanced, especially as we added board members with some great experience. But part of that, and we work in concert with our advisor, which was Callan at the time, and that is that, one, it has to have already met the advisor's criteria for institutional profile, risk, liquidity. I don't know if it's on their list, but we require all our managers are SEC registered, which not all are. You can definitely be involved with SEC. We can be definitely involved with investment funds that aren't SEC registered. In my experience, we've not gone with short tenured history investment managers. So these guys had over a decade. One of the, some of the other questions we generally ask is we like to see managers who have their own skin in the game. And very much so, this group had their own capital invested in the fund. Mr. Brackfeld's favorite, and with good reason, line of inquiry also focuses on fees. We have driven fees down as low as possible. We don't go for high fee managers. Like I said before, these guys are only paid when they exceed their benchmark, in which they were through at least December of last year. They were like 170 basis points net of fees above the index, so they kind of fit that wicket. Mr. Brackfeld, you can chime in. I'm trying to go through all the different things that we insure before, and then we have standard requirement ones, which are they're actually in the code or in the charter about fidelity bonds and stuff like that. But I don't even think they'd even get on our radar screen if they didn't have those standard provisions.
I think from Laurie's, Ms. Charlton's question, I think the short answer is that while I don't think it makes sense to discuss it in open forum, we are definitely looking at what our options might be, if that helps you a little bit.
Yes.
And
I get it. Listen, it's Allianz, right? I think they own PIMCO, don't they?
Very good memory. They own, I think, about 40% of PIMCO.
I'm sure I think they have well over $1 trillion in assets under management. So I'm not suggesting this is a fly-by-night, investment manager, and I'm sure you did your due diligence, and, there's risk associated with this stuff. And when you're trying to get, long-term rate of return of 7%, I understand we take risk. It just seems a little, I guess we'll learn more. It just seems a little vague in terms of kind of what blew up about the strategy, whether that was just, a bad, just a bad strategy in the context of a market that fell rapidly, or if it was something more than that. And I guess we'll have to see as more facts come out. But I don't want to take any more time. So thank you for the background on that.
We don't, it'd be foolish to expect that you have every manager. That's what we're trying for. You have every manager outperform in every market. We generally hoot to the managers that provide downside protection. So if you look through our portfolio, and I think I've talked about this before the Board of Finance, some of our managers do not many of our managers do not outperform when the market is just like last year, it's just up and up and up and up, and they all trail by a little bit. But where many managers can really outperform over a longer period is by not doing what Allianz did on the downside. So avoiding downside capture, we call it, is preserving principal, which over a long term, it's not hate to use the word sexy, but it's just not the exciting thing. But sometimes the tortoise beats the hare, and that's generally what most of our managers. So I would say that, part of the strategy with Allianz, that the downside put provisions there, the fact that they don't, and to answer your question, they state in their market materials that they are net buyers. So 1.8 times, I believe, is the marketing material. So, shock is the word. And so when you see stuff like that, you ask questions and you do what you've already asked. You look to the marketplace, because usually the marketplace is very efficient at sussing out what exactly happened. You also look at the behavior of the managers, because they're SEC registered and all their documentation that they put out and what they do post one of these things. And we never got to talk to the portfolio manager, which is inconceivable in my experience, actually being a portfolio manager, how you could have that sort of be that big of an operation. So we're talking Allianz, and how they, as an entity, would deem it okay to give some excuse for the portfolio manager and not have him explain. Instead, we had sales representatives / product specialists try to explain what happened, which, if you've got nothing to hide, then don't act like you have something to hide. We'll just leave it at that.
Okay, thank you.
Thank you, Ms. Charlton. Mr. DeWitt.
Thank you, Mr. Chairman. Chris DeWitt. Thank you, Mr. Vahey and Mr. Brockfeld, for coming tonight. I think your board deserves a lot of credit. I mean, I looked at these numbers today, and I mean, we're down, but you're down less than the S&P over that same period. So I think that certainly is testimony to the diversification that Mr. Brockfeld was talking about. But my question, and I'm definitely not going to talk about the details like Ms. Charlton has, because I just can't do it. But I'm curious. It seems as in the last couple months, there's been a lot of movement here. You're asking Caitlin, did we move money here and there? How will that all change and I'm assuming improve with this new structure you're putting in place with, and I forget the name of the acronym you're putting in place?
Oh, yeah, and I apologize for the acronym, OCIO, but all that it's outsourced chief investment officer. And I know Mr. Brockfeld covered it a few months ago, but they instead of being a consultant, they sign up for they're actually a fiduciary. So they're co-fiduciary. Our board can never absolve itself of its fiduciary duties, but in this case, they're legally riding alongside of us, and they do not have discretion, so they can't just go do whatever they want with the portfolio, but they work in concert with the board to work on the allocation and monitor. So in the case of, oddly enough, they were doing due diligence on Allianz because they went through our profile of managers. We knew commodities was not going to be, so we'd already said, well, that that doesn't fit with what Vanguard has in their profile, but Allianz actually, as an active equities manager, did, and of course we stopped that due diligence. But so that's what they would do that with on the private equity side. It's rather than us having to do all the questions and even we've done on-site due diligence, believe it or not, with our tiny board for hedge funds and stuff like that. So some of that gets offlaid onto somebody who can watch it every day. And given that the fund is, in the $500 million vicinity and actually going to grow based on projections, it's the prudent thing to do. And especially when we realize that the space has gotten so competitive that from a cost perspective, we're essentially getting this for the same expense that we had a consultant. And there's math behind that. It's some of that because Vanguard negotiates with some of the asset managers, drives fees lower. So we save money on the management side, but we pay Vanguard slightly more. So it nets out about the same, but you get the fiduciary stuff. I don't want to say, you're basically getting it kind of for free. So, great,
No,
great
Mr. Brockfield,
idea.
Mr. Brockfield did a nice job of explaining the OCIO to us, and I appreciated the conversation. I guess what I was looking for a little more simply, the mechanics of the whole thing is, if the OCIO were in place 2 months ago, and I hear about all these movements, would that have been facilitated faster? Or because I know when Mr. Brockfield talked to us, he said, sometimes a limiting factor is the fact that we have to all meet as a board and we have to all make decisions. But would that have, like your comment to Caitlin, did we move the money 2 days ago? No, we moved it yesterday. Oh crap. Well, I mean, that's just a timing thing. Would the OCIO have maybe facilitated that move a day earlier?
A lot of nuance. Believe it or not, we have a custodian relationship as well. So the money, we have managers, and then the custodian where money all rests, People's Bank, and then there's our body. And so there's timing in between all of those. But your broader question, we meet monthly, which we didn't always meet monthly. We used to meet quarterly when I started. And most of our managers, like the monthly rhythm, especially for some, we call them separately managed accounts, that would generally work. But to give a little shout out to my fellow board member, Mr. Brackfeld did reach out during the craziness of March and say, do we need to hold a special meeting? Do we need to do anything? And the great thing is all our board members have the same access to every manager. So all 14 of our folks can go to Wellington, Lexington, Mesereau, Allianz, and see what's out there as it's available. So we all get notified. So and that also changed since that was not always the case when I joined the board. And when you go through and look, when Mr. Brackfeld asked that question, I said, look, the hedge funds are down 4%. This is in the midst of craziness, which they're long short. So that's I expected that or better. I reached out to our real estate manager because not that I could do anything. The liquidity there is again only monthly, but everything looked and is run in such a way that I don't think that there was any movement. But even to answer your question though, so if Vanguard is in place, they still would have to get they would have to at least we'd have to call a special meeting to do something period. And they wouldn't be able to, move something without the board's approval. So we don't, it's not like we, you have on the retail side, you just have a broker that you give discretionary authority to your retirement assets and say, we'll just talk quarterly and you do whatever you want to do, and we'll just talk about it every quarter. It will still be a by direction sort of thing. And as far as what Ms. Bossy, we are net withdrawer, but we have to pay benefits for the current pension systems. But what Vanguard will do is work with her to know exactly when those are due and make sure that they work with the manager so we don't, like the board does not have to and she does not have to, so that she can do all the extensive stuff she has to do for the town and not have to worry about, oh my gosh, I got to call People's Bank and make sure the money is there because we have to write checks for all the retirees. That if Vanguard does their job correctly, that should run very smoothly. And that was another benefit of having, that sort of a relationship. Callan helped ask those questions and certainly help do it if we needed it done, but I anticipate it's more of a Vanguard will step in more effectively because they'll effectively have instructions that, hey, we're going to need cash on this day. So it should be a good, I think it'll be a good thing.
Okay.
And,
Thank
one
you.
one other comment on that one, Chris, would be, in my opinion, and I'm a strong supporter of our move to Vanguard, as I mentioned at the Board of Finance, I guess, a few months ago. Vanguard is going to help us streamline a number of things that I think will make it easier for us to attract good board members, right? Because I think people are busy in their lives. These are volunteer positions. And to the extent that Vanguard can take some of the busy work, if you want to call it, off our hands, it might be some soft advantage, so to speak. So it's just another good thing. It was a good decision.
Excellent. All right. Thank you.
Okay, thank you, Mr. DeWitt. Mr. Vahey, Mr. Bradfield, thank you for your answers and covering this quite extensively. Are there any other questions from board members? Mr. Walsh.
Mr. Vahey, how and when did we get into the Allianz Structured Alpha S&P 500 Index investment?
October or November, October and November of 2017. We had an equity review strategy. Might have been during that summer. It's part of our regular schedule to review all our different asset classes. And that particular investment, it was on their docket of large cap offerings, active management. It was presented as a potential alternative to totally being in. We were in the S&P 500 BlackRock ETF solely, and now you'll see we're in some Russell ETFs, and that's part of the whole equity market cap diversification. But that was when the conversation began. It went over 2 different months, and the manager came. I know the manager was there for 1 month. I don't know if they came for both months. So that was when we entered it, and great discussion as usual. And if I recall, it was a unanimous, but like I said, not without a bunch of just really great questions, because it's not. It's not an index ETF. It's got active management, and therefore the due diligence that usually occurs when you have an active manager. And I believe the decision was not only when we picked to go into it, rather than take a big leg, the decision at the time was to further to this is new, and something we hadn't done an options overlay, is that we only put $10 million in and said we were going to revisit, watch how they do exactly what they said for a year. It ended up being longer than a year. The tickler didn't work correctly, so it ended up being more than 18 months when we went and revisited it. But their performance during the whole period really was in line with what they said. And then we had another discussion about how much to add to it. And to Mr. Brackfeld's put a feather in his cap. I mean, we had a lot of discussion on how much that should be, and instead of doubling the exposure, which would sort of been in line with mixing up our diversity in the large cap space, we went half of that, I think, and so added to our exposure in October, November. Then that was last fall. So I think that's the extent of our contributions. And so our investment had grown, or I said, 172 basis points plus what the S&P did, which is generally all positive during that period. So the investment grew.
Who brought the investment to you? Was that something that Callan advised you that they thought you should get into Allianz?
Yes, so like I said, it's a, to my recollection, we've never gone into an investment that Callan hasn't approved, because that's sort of why we have a investment consultant. So it's, like I said, many of their clients and NEPC's clients, and I get them confused. I know state of Arkansas, state of Vermont, Alaska Permanent, and some of those are Callan clients and some of those are NEPC, but those are some of the other institutional clients of Callan's that are in the fund.
Okay. And you said that Allianz has about 30 competitors in the marketplace. And why did you decide to go with Allianz over the other 29 approximately?
Well, they're not all the same flavor. Like I said, there's also ETFs that have portions of the strategy. I mean, we could go through all the different ones. A big difference is many of them are active. Some of them have shorter track records. And they don't all follow the strategy exactly the same. Some, not to get too much in the weeds, but there's also the Madoff fund was supposedly a covered call strategy. That's a version that actually Allianz offers that also as a sub. That's another category that they offer from an options overlay. But my point being is they're not all the same. And matter of fact, I do not believe, to my knowledge, any of them follow the exact Allianz format with both puts, calls, and out of the money protection, and that's static, meaning they don't trade it actively.
Okay. Was this investment recommended by any specific board members?
No.
Okay. Did any of the board members ever work for Allianz?
Yes.
And who was that?
Jeff Mullen worked for them back in the mid-2000s.
Did he ever support the investment in Allianz to the board?
He only answered questions that were asked of him, and he abstained from the vote because he still knew folks that were there, which he didn't have to by our conflict of interest standards, but that was in line with what we would expect with folks on our board.
So your conflict of interest requirements allow you to invest in one of the board members' funds?
I'm sorry, that question.
Do you allow investments by your fund that you manage by one of the board members? If one of the board members is working for a fund, do you allow investments into that fund?
Certainly.
Okay, does that happen often?
There's an example. Yeah, I invested in Mesiro's private equity fund when I worked at Mesiro back in 2014, 2012. I refrained. I didn't bring the investment. It wasn't sourced by me. It was sourced by the Callan, once again, with that was a potential investment, and I recused myself from the discussion and voting on it. But yeah, I didn't get any remuneration for the town of Fairfield's participation in Mesiro's fund, and I didn't actually work for the private equity fund. I worked at the firm, and like I said, Mr. Mullen worked at that two places before. So if we're going to exclude investments in funds where people have worked at in the past, then we'd have to roll out Goldman, because Mr. Brackfeld worked there. We'd have to rule out several funds Mr. Trabucco worked at in the past, and I worked, at now what's now State Street. So I guess my point being is that we don't want a self-dealing provision. Is generally what you see for fiduciaries, and there's none of that in this particular instance.
Okay. And what is the self-dealings provision that you guys run by in the pension board?
That, as a lawyer, I think you know self-dealing means that you're receiving remuneration for some, you have a financial benefit from being from the fund participating in something that you have ownership in.
Okay, so you can invest in funds, but as long as you're not making a commission on it, then that's not self-dealing. Is that what you're saying?
Yeah, and our conflict of interest form is out on the website. You can go read through the nuance of it, but yes. That also didn't exist until sometime during my tenure when I had it put together.
Would you consider Allianz, the Structured Alpha S&P 500 index, to be an alternate investment? It doesn't seem to be a strict domestic equity investment because it seems to have all sorts of strategies with puts, calls, and all sorts of other things going on that clearly did not work during February and March. 100%
of the base investment is exposure to the S&P 500 through an ETF or futures contract. That is the bulk of what you're supposed to, we could have, like I said, could have been attached to an equal amount of treasury securities. The only portion that I guess is exotic that you're referring to is the overlay. So how they're producing alpha, and they're doing it using an option strategy that are all, I might add, exchange traded options. That was one of the other questions that we asked. They're not doing private OTC bespoke strategies. They're using standard market stuff. They're not registered as a hedge fund nor structured, particularly like a hedge fund in terms of strategy, leverage, or how they're marketed. Matter of fact, that same strategy is offered in mutual fund form. The fee structure and the liquidity stuff would be not something that we would participate in as an institutional investor because you benefit by doing the separate managed account structure.
It is a unique strategy, though, correct?
It is, and you can still participate in it today as in a mutual fund.
But the fact that, it suffered inordinate losses when the market volatility shot up in February and March does prompt some concerns regarding the strategy's execution, correct?
I think that's already been covered.
It's been covered in what way?
I think I talked about it about 30 minutes ago.
That volatility, their execution is, I guess, the point of whether you think we potentially could pursue litigation, correct?
I didn't use those words, but yeah, you did. Thank you.
Thank me, why? I mean, is that what we're talking about? I mean,
generally, if we need to go to executive session, then I'm fully fine with your body holding a vote and putting us there. But that's not what I was hoping to do this evening, and we'll keep this body abreast like we do every quarter. So we'll see how this all
I'm not sure we know enough yet. Baldwin's on the phone.
Well, I have no problem going into executive session. If that's what we need to do, I totally understand that.
This is Jim Baldwin, town attorney, and yeah, I think that if this discussion is going to go any further, I think it's appropriate to do so in executive session.
Okay.
Okay. I don't want to go in executive session and just to go into executive session. I mean, is there anything to discuss at this point that's worthwhile?
I don't believe so at this point in time. I think Mr. Vahey and Mr. Brackfeld have stated all that needs to be said, which is that things are being looked into.
Hey, Mr. Baldwin, when are we going to be in a position to go in executive session to talk about whether there should be litigation or maybe how the town and the taxpayers who pay into this pension fund are going to potentially be able to recoup their funds. When are we going to have that discussion?
Yeah, I would suggest that could happen as early as 2 weeks from now.
Great. Can we schedule a meeting for 2 weeks from now to go into executive session to have this full conversation? And I'll move on.
Yeah.
If the situation is right for that, Mr. Walsh and Mr. Brown, I would welcome the opportunity. I think it would be the appropriate thing to do, but we have to wait to see how things unfold.
Okay, so if I may jump in, we have a meeting on June 4th where we set the mill rate. And if we have reason to go in executive session, Mr. Bowman, just let me know and I'll make sure I put it on the agenda because it really should be on the agenda if we plan on doing that.
Of course, absolutely.
Thank you, Mr. Baldwin. Mr. Walsh, anything else on this subject?
And Mr. Brown, it's Ken
Yes, sir.
Brackwell. Just since usually Brian comes, and I'm happy to also be attending. If you guys could let me know if that's going to be necessary, so I can put that on my schedule.
Will do, Mr. Brackwell. And Mr. Vahey, so we meet again on June 4th, which I believe is a Thursday, and we'll let you know plenty of time if that's well, at least we'll let you know that week. But you can put it on your calendar, at least for now, for June 4th.
Thank you.
And yes, thank you, Mr. Chairman. I also said that our own body, the Joint Retirement Board, has not itself had a chance to even go into executive session, so it is a bit premature, but most definitely. I mean, if it was available to discuss tonight, certainly, we want to let you guys know where things stand, just like we would at any other event like this.
Thank you, Mr. Vahey.
Just one other thing, Mr. Brown, as chairman, could we also just be prepared to talk about Callens and whether there's any liability from that in executive session on that same time?
Yes, we'll put that on we'll make sure that we discuss that during executive session as well.
Mr. Vahey, in regards to their strategy, it seems to have a hedge component. Why wasn't it considered to be a hedge fund? Because it seemed to be that they did try to hedge risk with what they were trying to do. It just didn't work during this marketplace.
There are multiple, every active manager can put in stop loss provisions in their strategies. That doesn't make it a hedge fund.
And what's the difference?
Are you asking for a formal SEC definition of what a hedge fund is and its registration requirements, or, general nomenclature, behaviors? I mean, it's an institutional marketplace, not utilizing extreme leverage, not marketing itself as a hedge fund platform. You don't generally see a hedge fund strategy as a mutual fund offering, which is available to all retail investors. They have a market hedge component, which should be no different than a fixed income manager having, an overweight to treasuries, for example, or buying interest rate caps or floors as a hedge preventive thing. It's more a matter of what a manager is willing to pay to execute a strategy, because, like you said, hedges they cost money. They're not free. So if you're going to put something on, you're going to expect that your performance against whatever you're measuring is going to suffer unless you have something to offset the cost of that hedge.
Okay. But this investment was different than, say, one of our index fund areas. The index funds, say, like the Russell 3000 index or the BlackRock Russell 1000 index, correct, in their way that they did try to hedge risk with their puts call strategies and things like that.
Correct. One's a passive investment and one is an active investment. Correct.
Have we always had an active investment in the domestic equity?
Before Mr. Brackfeld came along, we had many active. Matter of fact, I think when I began, it was 100% active and approximately 40% hedge fund exposure back when I joined post Madoff. It has since evolved into 5% hedge fund exposure, and then we have real estate, which is an alternative. So when you speak of alternatives, I think you need to include anything that is not a vanilla equity and vanilla fixed income. So, I mean, you certainly could call the option overlay an alternative or something that's different. So if you go through our portfolio, we've got commodities, real estate, absolute return, which has got all sorts of hedging and options and derivatives and futures contracts embedded in that Invesco absolute return fund. But once again, that's alternative and different, and we can go into the reasons why that one was put in there. Then we have, PIMCO Global. We used to be all domestic, and now we became international. I can tell you in the large cap space, we've been through at least 4 different managers in my 10 years. Iridian out of Westport used to be one of our large cap managers. I forget when we moved on because of expense and underperformance over the long term. Mr. Brackfeld, can you remember some of the other active ones that we just left? Boston Company.
Boston Company,
Jensen
right?
was still in. Boston Company, we just left after 17 years, active manager. And the interesting thing, I think I pointed out to this body, was we left that because they had management change and ownership change of the overall company. But the remarkable thing was before that occurred, that transition occurred, that they were one of the rare examples, I guess, that over that 17-year period net of fees, we actually got 75 basis points, which would have been compounded over that period of alpha, excess returns. That's awesome that manager for that long track record. But I mean, that's what you try and shoot for. But like I said, it's hard to find. And our board has gravitated towards more passive stuff because the focus on fees and what the fund actually gets out of it, like net return.
You mentioned that before that we had been in a lot of active managed equity funds, and that's what Madoff was, correct? At least that's what we thought it was.
Yes. Yeah. No, matter of fact, I mean, I'm saying not before me, but I'm saying just in my 10-year reference of being on the board, it was kind of, we didn't have reviews for the Board of Finance back then, but oddly enough, it was classified as a fixed income investment. I'm not kidding about that. So then there was a rationale, but that was because it produced, right, it was covered calls.
Yeah.
Well,
when you have 15% a year, I guess it's kind of fixed, right?
Well, because it created income from selling call options. I don't know. Yes, yeah. And it was classified that way in the portfolio. So, would it be fair to move Allianz into the hedge fund thing? Certainly, I could, we could have that discussion. We could have moved it there. I go back and ask Callan, should we put it in that bucket? Our allocation allowance for hedge funds is up to 15%, I believe, by our IPS. And so we're sitting at, I don't want to speak, aren't we sitting at 5? I mean, so we could have put it in that, that bucket. But we felt that the bulk of that exposure and the behavior of it should have been like the S&P 500. If there was any deviation from that, it was supposed to be on the order of like 100 or 200 basis points, not what it did.
But it's that hedge component, I guess, is what really blew them up. When this happened.
No, unfortunately, the lack of what we believe is supposed to have been there. That, right, if you had the hedge, the out of the money thing that's all our marketing material, that was supposed to be the, glad we had that, because, it took the edge off of a massive market decline. It was actually designed, according to them and in their material and in their models, on the 1987 one-day event. So they, which was, I forget what the amount of that movement was that day, but it was
22%.
22%. Thank you, Mr. Blackwell.
No
so that's how they designed it. So, the market went down 31% in this instance over 12 days. So that's why we're investigating things.
Yeah, because it doesn't seem to make any sense, because if you're saying that they didn't do the hedge component of their investment, and they were really just S&P 500, why didn't they perform like the S&P 500?
Yes, sir.
Jim?
Yeah. Hey, Ken.
Hey, how are you? I'm good, thank you. It's a wonderful time. I just would suggest, and I welcome your questions, so keep them coming, but Baldwin is on the line. You might be venturing into areas he may not want us to go. That's all I'm saying.
All right.
Until we do the executive session.
All right.
And
Jim will
say
speak up
one
when
other.
he feels like he needs to, I guess.
And, Mr. Walsh, I just want to bring up one other thing. We were talking about hedge funds and sort of like remedies and investigations. Hedge funds generally don't confine themselves to, they can pretty much, they do file nowadays, many of them with the SEC, but they don't have to. But they also generally don't say, nor are they going to be held accountable for what they do. So they do have a sales pitch of what, their experience and what they specialize in, what they do. But if they wiggle out of that, you usually don't have any recourse. I mean, you can take your money back, but pretty much have given them money and some faith that they're going to execute what they say they're going to execute. And the good ones, that's what they do. But when you get into the realm that traditional money managers are registered investment advisors, like an Allianz shop, like the places that I worked at. I've worked at both the hedge fund and registered investment advisor. If you put out materials and say that this is what you're going to do, and you market it as such, and that's what you're expected to do. I'll leave it at that.
Okay.
That's a difference from a hedge fund.
Yeah. And when you guys went back and were looking at this investment, were you guys chasing returns at that point in time as opposed to going with safer investments?
Mr. Brown, this is Attorney Baldwin again. I just think that we're going a little too deep here than is necessary or appropriate under the circumstances. And I apologize, Mr. Walsh, but I'll leave it at that.
All right, thank you, Mr. Baldwin.
Do you think this is getting into litigation area? My question. I just want to know why they were trying to get into this alternate, what kind of alternate or hedged type of investment, and was it because of higher returns? Is that what they were seeking?
Mr. Walsh,
I
think it's appropriate for executive session discussion to answer your question. And it's a perfectly good question.
Right, and I can ask on a broad perspective, because it's a germane question across the entire portfolio, right? So it goes back to active versus passive. So when you say chasing returns, I wouldn't use that language, but the term alpha right, is anything that's above beta, and beta is your market. So whether that's the Barclays aggregate index, whether it's the Goldman Sachs commodities index, whether it's the S&P 500 or the Russell, that's your beta. And you're like, hey, I can just put it in this passive thing and I'm going to get that. When you talk about alpha, that's supposed to be returns that essentially are above that index or that proxy that you're measured against. And if you're going to choose an active manager to do that, you have to weigh the likelihood of that occurring versus the payment, how much you're going to pay them, because now you're going to have to pay a management fee that is going to be orders higher than that passive investment. And that's one of the things that we evaluate with every single asset class and every single manager. So passive. So we focus on the active passive question, the asset allocation, then within the asset allocation, diversification, and then the active passive question, and then the management. And then there's a series of questions, obviously for an active thing, a passive one, less questions because it's more, who are you, what vehicle are you using, and is it the best one to be in? So that, to your point, so you wouldn't pick any active manager if they weren't not going to provide alpha. Then the converse is that you're paying them something to do something you could just do passively. So you're always looking to try and increase your returns. And honestly, that's why on our report here, when you see, hang on, I lost it on my phone, but on the bottom of the last page, where it has the what's it called, the target return. The target return is really the passive component. So if everything was passive, that's right, what you would expect. And the realized, so big picture is, and it's off by 2%, that meant that all our managers together dropped the ball, like they didn't do in that period what we'd expect. And we watch that over longer time periods and then have robust discussions about, well, look, who is it that's consistently, like, we're paying people here to do something and they're not doing it. And that's how we usually start talking about replacing managers, and have we given that investment strategy and manager a long enough time to execute the way that they said they're going to do it? Like, is it cycle influenced or idiosyncratic event that messed up a certain strategy? And it's not, that's the job we're tasked with as volunteers in this board. And but it's a good question. It's a very germane question. I think on a broad topic, it's a fair question.
And to use your language, I'll just follow it up. Is in regards to the alpha investments that we do make, it's not just the fees that we have to obviously pay a commensurate fee for that expertise, as you mentioned, and I totally agree with you with that. I mean, clearly, obviously, you're paying for that expertise and that history and what they've done and their philosophies and their models and their strategies. But that also comes with a commensurate risk, I would imagine, slightly, or hopefully it's slightly, but it does come with some risk, because if I keep wanting to say case returns, but if you're pursuing alpha, there's always a risk-reward kind of proposition, correct?
Yes, sir. So I don't really want to. I definitely see everybody's somebody asleep there. Things that we look at are we look at things like Sharpe Ratio, Sortino ratio. Another way we look at downside capture, upside capture. We look over various time periods. We look at standard deviation, which is the most simple risk measure, and we look at it on a portfolio basis, and we look at it on individual. So you are correct, and that's what we're always learning about, and that's what all our board tries to do in conjunction with our consultants.
Okay, because obviously this one didn't work out too well. And another active one we don't seem to be doing too well sometimes with the active ones because, like, Madoff was obviously inactive, or as you said, maybe it was something else. Maybe it was a fixed, fixed income, or whatever you said it was categorized as before, which is actually quite shocking.
It's
But
actually fraud, to be perfectly honest. Right.
it was actually fraud. Ken.
Right.
You're 100% correct, but it wasn't categorized as fraud, unfortunately, on our listing. No.
Right.
So it also wouldn't have fit much of our due diligence that I described. Like, it would have failed. And to Mr. Walsh, also to point out, not to belabor the Madoff thing, but believe it or not, Town of Fairfield got into that investment. Our advisor recommended it. Like, no,
Yep.
our advisor they were the manager. Like, they got compensated for actually putting the Town of Fairfield in it, which is that would, from a conflict basis, that's inconceivable. But that's how we ended up in it. Tremont, I believe.
Yeah. Mr. Brockfeld, did you vote to go into this as well? This fund?
I believe I voted yes, original vote, and I believe I voted no for the second helping.
Okay. Okay. I have no more questions on Allianz. I do have some further questions, but I'll let other people jump in.
Well, I'm about ready to move on to OPEB, Jim. So if you have other questions, let's get through them, and then we'll get
Mr.
going.
Bain, how do you think other than Allianz, we did comparatively to the general marketplace? Did we outperform in certain areas and underperform in other areas, or you think we did pretty well going with what's going to happen in the marketplace?
That's
this past quarter.
It's a good question, and the easy way to, and you can actually, that's great, they're going to do OPEB. So when you read all the headlines, they're sort of meaningless because you can't, everything has to be put in context, like you talked about with risk and return and the way, it all comes down to asset allocation, honestly. The bulk of the returns are driven by how much equity exposure you had at the end of the day. And the Town of Fairfield, we're not light. I mean, we have about 60% exposure to equity. But honestly, the more that you have, it's because it's got the higher return profile. We have a targeted return of 7%. You're not going to get to 7% by us all being in the fixed income space. It's just not feasible. And that sort of drives how the returns shake out. And if you go and look at all the other different funds, it's not like, unless they have some managers, like we spoke of, that just way outperformed, they're going to basically fall in line with how much equity exposure they had. And so you can see the return for, it was down 9, I think, for the main one. If you look at OPEB now, which has more equity exposure, I guess it's the same. Did I open the wrong one? I opened the wrong PDF.
The OPEB last month, Brian, was down about 10.2%,
Mm-hmm.
and the pension fund was like
9.45.
Yeah,
9.45. So pretty close.
And really the difference was OPEB has higher allocation to equities because they can't have the diversification, which we've talked about, because they're not big enough for us to, as a trust, to get some of these managers to manage some money. So, I mean, so when you see in the newspapers some bigger pensions having just horrible results, if you peel the onion, it'll be because, like, I haven't seen City of Hartford, but I know City of Hartford runs like a 70-30, like our OPEB. So I'd expect them to be in the 10-13%. The state of Connecticut unfortunately has a heavy equity exposure because those funds are all underfunded. And when we talk about how pensions sort of long-term fund their obligation, 80% give or take 60 to 80% of the overall funding actually comes from investment returns, not contributions. So if you're way under, either you're making massive contributions, or you try and stretch for those returns, and it gets into a dangerous, you have to add risk. Anyway, sorry for the long answer.
Do you think people, like funds that do that, like the state of Connecticut, also have higher returns actuarially? Like they might be at 7.5 or 7.25, so they're chasing it to try to have those returns be in equities?
They do, although the state of Connecticut just moved to well, not all. They have multiple pension trusts, but 6.95 is what one of them just moved to, and I think the teachers is still at 7.5. So yeah, to answer your question, yeah, they keep it up there, but that's also they're shooting for the higher returns, so they can justify the higher discount rate. But one might argue that what their true, can they achieve that rate, and if they used a more realistic discount rate, their liability is actually bigger. It's not just the state of Connecticut has that problem.
I have no further questions regarding the pensions, actually.
Okay, thank you, Mr. Walsh. Mr. Vahey or Mr. Brackfeld, any further comments on OPEB? You touched on it a little bit. Anything you want to add?
No, the beauty of the OPEB is its simplicity. So, as Brian stated, for better or for worse, by the way. So the results speak for themselves, and they're not that far off from the pension anyway. So.
All right, thank you, Mr. Brackfeld. Any questions on OPEB? Mr. Walsh.
This is a tie-in between OPEB and pension, but as Vanguard, which I see is the primary investments in our OPEB, as they come in as a co-fiduciary, how do they feel about these active investments in equities? I mean, are they a little more conservative about it, or how do they?
So they purport. Are you done? Sorry.
Yeah, I'm done. Thank you, Brian. Thank you.
They use a process not unlike ours, except they have a giant staff, and they do it every day. So they filter down the universe of active managers, say in the equity space, and like Callan did as well. And then they select a group just like Callan did that they're comfortable with, except that the difference between Callan and Vanguard is if we were with Callan, then we actually have to then go pick from the list and do our own question stuff, and then we're stuck with whatever fee that manager offers us. I mean, we don't have a lot of leverage. In the Vanguard situation, they pick a cohort that would be, say, we'll call it U.S. equity, and they've got a basket of managers that they're comfortable with. And I believe the way it'll work, unless we direct otherwise, we could pick individual ones, but what generally will happen is, like, we'll say, hey, we believe we're supposed to have 40% U.S. equity for our portfolio. We'll be put into that basket, and they'll manage those managers. So they'll always tell us who's in there and how they're performing, but that's all. They do the selection and handle the risk of on-site visits, management reviews, portfolio reviews, and remove managers, add them, and that takes hours off of what our board does, the poor board, because you can go look at our minutes. When we're interviewing managers, it's 10 o'clock, 11 o'clock. It takes a long time to do this, and that's. I think Mr. Brackfeld said the ability to attract and retain people to be on the board, be not having 11 o'clock meetings, and so that answers your question. And Vanguard also puts passive in there, or they'll give you a completely passive. So you could pick a passive option, or they're active or a blend, but they handle the managers that are behind it and the fees. So they negotiate with big dollars and push the fees way down, which is an added benefit for the pension.
Thank you.
Thank you, Mr. Walsh. Any further questions on OPEB? Okay, seeing none. Mr. Vahey, Mr. Brackfeld, thank you very much for being here. Appreciate the time and your answers.
Thank you. And we'll be available for that June meeting if you need us.
Great.
Thank you, everybody.
Let's plan on that, and I'll follow up. Thank you both.
Okay, have a good evening, everybody.
Yes, likewise.
Okay, we're on to item number 4, to review the Board of Ed's Q3 fiscal year 20 financial position. I see Mr. Cummings is here. Ms. Munsell is here. Our liaison to the Board of Ed, Mr. Jeff Peterson, is with us. And I see Ms. Vitale, Chairman of the Board of Ed, is with us as well. So, welcome. And the spreadsheet looks, I don't know who's going to review it, looks pretty much the same as we just reviewed a couple weeks ago. But I'll turn it over to Ms. Vitale. Who am I turning this over to? Mr. Cummings?
I'll take it.
Okay.
Good evening, everybody. Thank you for the opportunity to talk about the Q3 report. And it is very similar to the report that you reviewed a couple weeks ago when we met with you. I'm going to ask Ms. Munsell to review anything, any updates, and of course, we're here to answer any questions you might have.
Thank you. Ms. Munsell?
Hi, Doreen Munsell, Executive Director of Finance. It is the same document that you received the last time that we reviewed. We didn't have any information that we could get into a document format, or actually that we finalized. We do have one more month's worth of electricity, and we were analyzing that today, but we weren't able to finalize that. We were hoping to for tonight. It obviously does look better, but I can't, I can't give you a number. We haven't received all the invoicing for heat for April. We are doing, our biweekly pay period is next week, and we'll do another analysis of salaries. And health insurance was staying stable. So those are the big ticket items. There's nothing else to report as far as change.
Okay, thank you. Just a question before we get to the spreadsheet. Has there been any more information coming from the state in regards to the CARES Act, or any additional assistance that we may receive as a town due to COVID?
No, we've not gotten anything more than we had previously reported.
Okay, thank you. Turning it over to the board for questions. Are there any questions on the spreadsheet? So, Mr. Cummings or Ms. Munsell, is the savings that we discussed back a couple weeks ago, that hasn't changed either?
No.
The Board of Ed has been on here for an hour and a half, and I was asked to bring them on, so are there any questions? Otherwise, I will owe them an apology.
It was a gripping discussion. We were happy to be here.
Yeah.
It was, those discussions are getting more interesting. I want to admit.
I learned a lot.
Mr. Walsh?
Who would ask the question to maybe Ms. Munsell, or maybe it's Mr. Cummings, but The bus savings that we saw, that you were able to report out, and I really appreciate you doing that work and getting us that number. It's like $468,000. Is that correct?
That's correct.
Was that just for public school, or was that also for non-public transportation savings? How does that work?
Go ahead.
That was for the public schools only.
Is there also savings on the non-public transport?
Yes. And I don't know, Caitlin, if it was yesterday or today, I gave them the number, and I'm leaving up the choice to them of whether or not it would be an credit on next year or a refund for this year.
What's the number?
185.
$185,000?
Yes.
Okay. Are we taking that the same way as a credit towards next year?
I don't know what decision was made on that.
Caitlin, has there been a decision made on that?
No, we just got the number yesterday, so I haven't discussed it yet with
All right.
the administration.
So no one's talked about it yet?
Well, we just got it late afternoon, so we plan on discussing it, yes.
Okay. Because that obviously can either be a savings, hopefully, towards the budget for next year. I mean,
correct.
We already have a surplus, right, that we're going to have already for 1.3, at least estimated for right now?
Correct.
Okay, so...
I'd imagine, I'm not sure if the RTM is going to be voting on, if that's part of their vote on June 1st or not.
All right. Well, Ms. Kupchik's on the phone now, right? Or she's on the video. Although I don't think she's listening.
I think it's more on the video right now, Jim.
What?
Brenda.
Yeah, this is Town Attorney Jim Baldwin again. I can speak to this possibly. We just did get that information, and we essentially have to vet the numbers that were provided to us, and that's what we intend to do, but that hasn't been done yet.
Okay. Well, that's great news that we'll be saving $185,000. I mean, it probably makes sense at this point to apply it towards next year's budget season, just like we did on the public school transportation number. Since, at least for right now, the way it's looking is that we're going to already have a $1.3 million surplus that I guess we're going to be talking about in a couple of minutes. And we could probably use it for the taxpayer for next year.
Mr. Chair, can I just dovetail off of what Mr. Walsh is discussing?
Go ahead, Jack.
Hi, Jack Castani. I just want to ask a question in correspondence to what Mr. Walsh is discussing on the transportation. Does that include is there any special ed savings, or is there cost involved as well for special ed transportation, or how is that working?
Our number is all inclusive of special ed. Oh.
Okay, thank you. So the savings that you're discussing includes special ed, is that right, for the non-public transportation?
Yes.
Okay.
Okay, thank you, Mr. Tistani. Mr. Walsh, any further questions? Or Mr. Matolas, do you have one? I saw your hand raised earlier.
Question. Yeah, I have a question, but not on this topic. I had when you're done
Okay,
with this,
any
I have
further-
a question for Ms. Munson.
Okay, thank you. I'll come right back to you then. Any further questions on this topic? Okay, Mr. Matola?
Yeah, thank you, John Matola. Ms. Munsell, when we met a couple weeks ago, can you remind me what is the figure for that can be put into the non-lapsing account? What's the most? Was it 2% of last year's budget? I'm just trying to remember that figure again. Wasn't it like $3.6 million? Was that the figure?
Yes, it's 2% of this year's budget.
This year, yep. Okay. And that was around 3.6 million, if I remember correctly?
Correct.
Okay, that's all. Thank you.
Thank you, Mr. Mottola. Any further questions for the Board of Ed? Okay, thank you for being here.
Thank you.
Thank
Good
you.
evening.
Thank you. Good night.
Okay, we're going to item number 5. To review the town's Q3 fiscal year 20 financial position. So, Ms. Bonasi, over to you. Do you want to start with the projected net estimated operational variance?
Yes, please.
Okay, turning it over to you.
Okay. These figures are similar to the Board of Ed. They're similar to the last time we discussed. I think there's about $100,000 difference, just some tweaking. But we can go down the line. The biggest change on the revenue piece is the favorable, approximately $150,000 on the investment income due to the good performance in April that we spoke about on the pension and OPEB accounts as well. Slight change to the fire marshal fees went up slightly, and then I adjusted those due to actuals. And the other revenue actually got worse slightly just by a little bit in the room rental fees in the library. So other than that, the revenue is projected to be pretty much the same as it was a few weeks ago, other than a development came in yesterday, piece of the ECS grant from the state, and it was actually $275,000 more than we had expected. So that state revenue number is now not a negative 103. It's actually a positive 172. So that helps out on the revenue piece as well. Does anyone have any questions on the revenue side?
Caitlin, this is Jim Brown. When we looked at this a couple weeks ago, is this the exact same number, minus 450?
No, so it changed slightly. I said due to the investment income was a 0, but due to April favorable activities, it's 150 favorable there. And then just slight differences in the fire marshal fees and the other to reflect actuals, basically.
So we're in better shape.
Yes.
Any questions on revenue? Mr. Testani. Jack, you're on mute.
Can you hear me now?
Yes.
Yes.
Okay, sorry, Caitlin. Just curious on the collection rates. I know it's not directly connected to revenue. Just wondered if you had an update as to where we are. If we're still on track for where we were, what was it, about a week ago?
Yeah, we're still on track. It's slowed up quite considerably as we thought it would now that the May 1st kind of deadline has passed. So we're still getting some mail opening and some office deposits, but we're still projecting to be on. And the negative is really due to, again, that tax sale that was budgeted. So that's what the negative 700 really represents.
Okay, thank you.
Thank you, Mr. Testani. Mr. Walsh?
Under the explanation for conveyance taxes, it says timing. Favorable refinancing rates resulted in increased activity. How does refinancing rates have anything to do with conveyancing?
On the town clerk revenue?
Yes. Yeah. It says favorable refinancing rates resulted in increased activity. If you're refinancing, you're not buying a new house. So I don't know how that would increase conveyance taxes.
I'm not sure. That came from the town clerk. I could follow up.
Okay. I mean, maybe it was favorable as rates, borrowing rates or something. That would be the only thing that can make sense to me. With the increase in state aid, you said it's $172,000. Does that mean that the estimated fund balance would go up to $1,488,000?
So if you add on 275 to that, yeah.
275?
Yep.
What's the 275? I thought you said that the state aid went up by 172. Is there another adjustment?
No, I'm saying it was a negative 103, and now it's a positive 172 because it went up $275,000.
Oh, okay, 275. I'm sorry, I misunderstood you. I thought you said that it went up by, increased by 172, not that it turned into $172,000 positive. I apologize. So it would go up by 275, and that would raise that to $1,541,000, I guess. If I'm correct. Okay, I have no other questions in regards to revenue.
Okay, thank you, Mr. Walsh. Ms. Massey, let's go to expenses.
Okay, these numbers again are similar to, I think, the last time. The only thing I really did was I tacked on that COVID expense piece from the COVID sheet to show the town estimated share of the projected COVID expenses. That should have been another handout that you guys got. So really, the COVID, we have savings, we have expenses, and we have loss of revenue. So there's kind of three pieces to this, so it kind of gets a little confusing. We see the loss of revenue up in the park and rec revenue piece. Then we have COVID savings, like we talked about. The majority of it is part-time or departmental savings, and then offset by unemployment costs. And then you have the CARES Act piece to that as well, and then you have the actual COVID expenses that were on the separate sheet that had 294 is the projected town share of the COVID expenses. So those numbers came in from all the departments. I think the last number you saw was an actual number as of mid-April. So this actually, we reached out to the departments and said, can you give me any type of projection through the end of the year?
What were the big changes on this form?
There wasn't a lot of changes.
There wasn't a lot of changes from mid-April to the end of June?
Oh, I'm sorry. Oh, on the actual. You should have. Have you? Which has the 660, and then it goes down to the 294. I believe that number before was like a 201 number. As of mid-April.
And 659, 531 was how much? What number was that?
I believe that was a 600 number. I'm not sure I have the actual April one in front of me, but this is projected through the end of June.
Wow. Wow, this number's big.
Ms. Charlton?
Thank you, Mr. Chair. Hi, Caitlin.
Hi, Lori.
Question for you. and maybe this was shown this way before and I just didn't notice it, but the COVID number, 294,000 is net of the 5% FEMA reimbursement of 343.
Yes.
We wouldn't record the FEMA reimbursement now, right? Wouldn't we hold off on that and wait until we actually get it?
No, I would accrue for the 75%.
So this number is a sure thing, you're saying?
No, I'm saying this is our projection given, so I ran it by the auditors. My auditor was in the other day. And otherwise I would have to record expenses of really 457, right? Because we know we're not going to get reimbursed for our regular pay.
Right.
And we already filed, actually, we were advised to file quarterly. Someone in my office already filed through March 31st, $100,000. So we're hoping to see what the turnaround time is for that as well, because we technically don't close our books. So we still have time to kind of get a feel for what the receivable is going to be.
Okay. Yeah, that was my concern, is that the collectability of that FEMA receivable. I mean, regardless whether we qualify and this is cut and dried, we know how FEMA is, right? And there's some unpredictability there. So I guess what I'm wondering is, when we go back and we look at the projected surplus for the year, right? That's that 1.3 million. That assumes that we'll get, that FEMA reimbursement is assured enough that we'll be able to record that receivable and that we're confident that it's 100% collectible. If we don't get to that point, then the fund balance or the surplus could be reduced by that 343,000, right? Which would, worst case, I guess, leave us with a surplus of roughly $1 million or a little bit shy of $1 million. Am I understanding that right? Okay.
Yes, and I'm hoping, like I said, by the time this all happens, if we file kind of timely, and we'll see what happens with our March filing, that we'll have some comfort to know what exactly we're going to be getting. We're hoping. So we have some time to record the actual receivable for the June submission.
Okay. And when was the last time we filed for FEMA money? I mean, was that back with Sandy, or have we done this more recently?
Our big filing was Sandy. We have a Penfield Pavilion filing with them, and we also, I'm not sure if any of our other grants are actually with FEMA or not, that the town is currently involved in.
Okay. Yeah, I'm just wondering how much of a sure thing this is going to be. I mean, clearly it's the right thing to capture everything that we believe fits into the criteria and apply for it. But, who knows if they're going to be amenable to, some of these things like legal expenses, how much overtime, what proof do you have to put in. So I guess we'll just have to wait and see on that. But as it stands now, if that fund balance, I guess, could be a range of, what we've got now, sort of the high end minus $343,000 on the lower end, if we were not able to, record that as a receivable that, collection was assured.
Yep.
Okay. And then just circling back to Mr. Walsh's question on the private school bus transportation, I thought, and I might not be correct on this, but I thought that the Board of Ed, they were getting that as a credit to next year's school bus contract, and that's just the way that was negotiated. Do we, on the town side, do we have a choice to get a refund of that versus get a credit toward next year?
That's what Doreen informed us. We got informed of this yesterday. There is, the Board of Ed actually sets our budget for that line item.
Yeah. Okay.
So she told us yesterday that unlike her side, our side, there is a flexibility. And again, we just learned this yesterday afternoon. So
Gotcha.
again, that number comes strictly from them. We have no input into it. So I'm not even sure, you know, I haven't talked to the administration about it yet at all. Like I said, we just got it yesterday. So I don't know if the RTM is going to act on it or if we have a choice or not.
Okay, but there is at least the potential that that could be a refundable amount versus having to take it as a future credit toward next year's expense. And I realize that would have a budget impact. It would, you know, if we got it as a refund, it would, you know, go into our current year surplus versus as a, you know, refundable credit. Well, I guess I'm not even sure because it really depends on whether you record it as a receivable, right? So, okay. So yeah, I guess we'll, you know, I guess the interesting point on this FEMA reimbursement is we're just going to have to wait and see what that looks like. And so the amount we did file for already was $100,000. Do we have any sense of the timing of when we might know what they're going to give us back on that?
No, I asked my staff member in the office is doing it. So everything's online, and she probably has a binder about 3 inches thick on just that 100,000. And I did ask her that the other day, and she has not been given any time frame.
Okay. Yeah, God knows what they're processing on their end. It could be years for all we know.
Yeah, and the documentation that's really needed, just to give you an example on the overtime, is you have to show every person who worked overtime, not just the overtime that they worked for that day, but you have to prove that they in fact worked their regular shift first. So we have to go through every payroll warrant that we have for every person that we're submitting overtime for to actually prove that they worked either the 7 or 8 hours or whatever that normal shift is for that day, for that person, for every single person who worked overtime. So it's extremely detailed and time consuming. So we're working on it.
Yeah, I mean, I hope I hope I'm wrong, and maybe the federal government will be super efficient on this, but you know, my sense is that, you know, that's at least questionable, right? So that in terms of knowing the collectability is assured. So, you know, I just want us to keep that in mind in terms of the surplus we're projecting could be less by that, you know, that projected 347,000. So that was my main point, I guess.
I mean, it could, and we did, in terms of Sandy, we did get the 75%. It took a while.
Yeah.
But we did in fact get it. So, I mean, I'm not saying there's any guarantees this time, but,
Okay. And was Sandy, were the nature of the expenses that we applied for similar? Was it things like overtime, or was it more material? No. Okay.
No, it was more debris removal. That was a big one. And they were actually contracted services. And then there was a lot of security and safety measures involved, but a lot of it was the debris.
Yeah. I mean, I don't know, if I had to take a wild guess, I would think that, you know, there's probably more room for them to challenge something like overtime versus an invoice for contracted services. So it might be a little bit more lengthy or risky, but I guess we'll see. Thank you very much.
It was definitely a lot more involved, even with providing our fringe benefit rates for the uniformed versus non-uniformed and how we came up with that. And there was a lot of detail associated with that as well. So I agree, the payroll piece is a little more complicated.
Okay. All right. Thank you again.
You're welcome.
Okay, thank you, Ms. Charlton. We're going to go to Mr. Bateson and then Mr. DeWitt. Mr. Bateson?
Yeah, thanks, Jim. Can you hear me?
Yep.
Yeah, yes, we can hear you. Yes, go ahead, Ed.
Yeah, it's Ed Bateson. Caitlin, I apologize. I've had a bad weekend, and I just started to look at this document during the meeting, and the document I'm looking at here is the one I think you just referenced. It's projected department expenses. It's the one that has the 659 number that we were talking about, grand total.
Yes. Yeah. Yep.
Okay. I believe I recall seeing this last time when we were in budget what was that number the last time we saw it, 659? Did you say 204?
I don't remember, I don't have, that was an actual as of April 15th. This is a projected through June 30. I'm looking to see if I have the actual one in front of me.
Okay, so this is, all right, I'm sorry, I don't know, I can't speak for the rest of the board, but this 659 is catching me off guard. I don't remember this number being that high. So.
Well, again, the other one was actual through April, so this is now projected out through June 30.
Okay, so what was the actual through April?
I don't know that I have it in front of me. I'm looking right
So maybe I could help. Caitlin, can you hear me?
Yeah.
Can you look at $179,971?
Say that number again, Jim?
Hey, Ed, can you put yourself on mute?
Will do.
Then I'll come back to you. Just need to get Ed on mute. Dave, can we get Ed on mute? Thank you. Caitlin, if I have the right, I think we only received one of these, right? And what I have in front of me shows the grand total of $179,971, where you have 659 right now. Okay. Now what's interesting, I think, is that total COVID expense showed 210, and it's back then, and it's showing 294 now.
Right.
But just a big difference in the grand total.
Well, April 15th was probably only really, we started doing this stuff, I think March 13th, the emergency was declared. So, you know, a month, maybe a little over a month. So this gets you out through June 30.
Okay. Yeah, the question was, where were we back in the last time we looked at this? And the answer is about 180,000. So, Mr. Basin, I'll turn it back over to you.
Okay. Thanks, Jim. That's okay. All right. So that's what I'm thinking too. All right. These numbers are catching me off guard. All right. Let's go to legal. $55,000. What's that?
That's, I believe, legal expenses, and I'm not sure if Jim Baldwin wants to speak to it, but he's doing a whole bunch of stuff on the executive orders coming down from the governor, interpreting.
Okay, so anytime we get an EO from the governor, it has to go through the town attorney and see what the ramifications are on the town?
Correct.
Okay, police department, that one's catching me off guard. I didn't remember seeing a number coming out of the police department that high. So it looks like regular pay $107,000 and overtime $206,000. That sounds high to me. Just is there any explanation on that, or what are we doing above and beyond that would necessitate overtime for COVID? For instance, anybody that could answer.
I mean, I believe they are. And I don't know, Brenda, if you want to take this one on, but.
Yeah, I'll jump in. Ed, when we opened up the emergency management, emergency operations center, this is new to me, obviously, but the emergency operations center requires, you know, the fire chief, the case chief, and also fire and police personnel. There's a whole series of different mechanisms that are in place when we plan all of this stuff, the safety of the town. When the executive orders come in, they have to be reviewed by the town attorney, also by the EOC team, which includes first responders, health department, if it's business stuff, that it's zoning, but the health, the first responders are involved in all of these EOC meetings, these committee meetings. And then, for example, when we shut certain stuff down, we shut the town hall down for 3 days. We had to reopen. There was a lot of different things. We had police stationed at Old Town Hall and Independence Hall because we couldn't allow people in. and they were dropping off plans. And like Betsy, for example, had appointments for all her transactions. And you know how it is, people didn't know, and they were just come into the building. We had a box there for the tax so people could pay their taxes. So there was a box, one of the Santa Claus boxes that we had DPW sort of repurpose to put your tax payments in, no cash, but checks. And so we wanted, we obviously had a big box there with cash in it. We have staff in the building, people with appointments want to make sure they're wearing masks, make sure that they do have an appointment. Obviously, our employees were concerned. They don't want people just coming in to the building. And so we had that too. So there's a whole host of very complicated things that never in my life would I thought I would have known about all this stuff until now. It is a lot. It's a lot of different mechanisms and planning. Is collecting PPE for the first responders, also for the nursing homes and moving the nursing homes and putting all this stock stuff together. Helping out with making sure we had social distancing at our open spaces when we restrictedly opened. People felt concerned and they wanted they want a police presence there. I can't tell you how many people were emailing us saying, these people are coming in, or there's people too close, or there's people sneaking in, there's people parking all over the side streets in front of my house, and I don't want them parked here, and they're not supposed to be here. I can just show you a copy of my emails in 1 week from our residents. You would be flabbergasted. But anyway, so there's a lot of that too.
Okay, I see those explanations, and it sounds like the further we got along into this, it sounded like just the normal patrol duties weren't covering this. It sounds like you were getting requests, and the chief was just like, okay, normal patrol can't handle this. I have to bring in excess personnel to do this. Is that what I'm hearing?
Well, I'm not sure about
extra personnel.
Yes, I mean for checking for the open spaces, but again, the emergency management team, which met every single day for months, has first responders on it, and then they also have to go and then implement the things we talk about during those meetings, especially a lot of these executive orders that require specific things for public safety.
Caitlin, I want to go back to this document. We have the $659,000 in grant total, the 75% FEMA reimbursement. What's the governing document on that? Are we sure about this? Is this under the CARES Act, or how is this going to work?
No, it's not a CARES Act. It's through FEMA. We have some documentation that we've received. We've been trained through the emergency FEMA Connecticut training, and like we talked about, we got 75% from Sandy. We put in our first filing, and we're following all the rules, and we're going to see how our first filing goes to get a comfort level.
Okay, and then on this document it has the 659, and then it says less regular pay. Why are we subtracting that 201? Is that not collectible?
That's not reimbursable through this program.
Okay, and unemployment compensation expense not budgeted and not reimbursed. So you're thinking that's what the impact is on the people that have been furloughed?
Correct.
Can bite us in our comp rate, right?
Yes.
Okay, so total COVID expense to the town is $294. But not really, because on top of that, I have my regular pay of $201.
Well, they would have gotten paid anyways, I think, is the premise of not reimbursing that.
Okay, I'm sorry. This document caught me off guard tonight. I didn't think COVID was costing us this much.
Thank you, Mr. Basin.
The regular payroll would be an expense regardless. They're just what we're doing is we're just reporting COVID activities related, but that regular pay would have been a part of their regular salary.
I got you. I understand. I get the document. I just, the report, the way you reported it tonight, I just kind of caught me off guard. And it's taken me a while to absorb this. So, I don't know, Jim, maybe we can revisit this at a later date. I just wasn't expecting a number like this tonight. Sorry if I picked it up late in the game.
No, we appreciate that. I think we will be looking at this, when do we meet again? I mean, definitely before the fiscal year is over.
Yes.
Mr. DeWitt was next. Chris?
Thank you, Mr. Chairman. Chris DeWitt. I want to follow up on Ms. Charlton's comments about FEMA. I didn't even know FEMA was involved in this whole thing, to be 100% honest with you. And I think there's zero chance that we're going to get FEMA reimbursement before we call the end of this fiscal year done, right? Especially given our other FEMA issues are done. So it's my question to Caitlin, and maybe it's to the first selectwoman, is when we were doing all the Sandy stuff, we had like FEMA experts answering the stuff, and we still haven't been reimbursed. Who's doing our FEMA stuff for us now? Are we contracting that out or hiring people or what?
No, I have someone in my staff.
Sandy, but did we actually have FEMA experts, or did we just apply through our building, zoning, and things of that nature through the regular process? I know there was some missteps made with the Penfield back when Sandy and all of that, but I don't know that the town hired experts. I think it was just department heads applying for federal grants with the assistance of the federal delegation. But Caitlin, you could speak to that. I don't really know. I wasn't here.
We did hire a firm called Witt O'Brien.
Oh, okay.
We did. But the Sandy costs, I have to say, were in the millions of dollars. It was a lot higher than these dollar amounts, and so maybe that was part of the reasoning of why they hired them.
See, my recollection. Yeah, my recollection of the forget the dollar amounts, right? But my recollection was that we were told by the administration that, you know, if you don't file FEMA paperwork in the exact right way, dot the I's, cross the T's, underline this letter, that you're not getting your money. And we paid for a consultant, and we still haven't gotten our money. So, you know, even though this may pale in comparison to the money that we've been reimbursed for Penfield and all, I'm a little concerned, like Charlton is, you know, at the end of this year, are we going to drop, you know, 343,000? This number is going up a lot, and I'm not saying the number shouldn't go up or whatever, but you know, I don't know what we're going to do. How are we're going to drop this to the bottom line at the end of the fiscal year, or can we just keep this as an encumbrance on the side after the fiscal year is closed?
Well, don't forget, we have a few months after June 30. I mean, I don't need to, the receipt doesn't have to happen, you know, July 1st. We're still closing the books. We still have accounts payable open through August. We do our transfers in September. So there are some months to feel everything out as to all these reimbursements. And again, we filed one the other day, and we'll see, you know, maybe it'll come in timely. I mean, I don't know the staffing at the FEMA level. I mean, I'd imagine every municipality in every state almost across the United States would be doing this. So,
I mean,
well, my understanding, Chris, is that, Caitlin, you can chime in, but my understanding is the town was reimbursed a lot for FEMA, different things, and so were a lot of the residents who suffered damages to their home. I think the thing we've still been waiting on is the Penfield, because of some problems with that application. I think there was some issues with that specific application that caused that delay. But I think there were reimbursements on other items, you know, debris removal, like Caitlin was saying, and cleaning up the sand and sewers, and all National Guard and all that. But I think Penn is the one thing that's still stuck in waiting because of some, they said it wasn't built the right way or wasn't built to FEMA standards, and that's what caused the issue. My understanding from the FEMA requests on COVID, we have been instructed by the state and federal government to be sending these in, and that they're expecting these expenses for towns. We have to spray everything. We have to clean everything. I mean, there is a lot of things that have to be done for us to even operate our town in the manner in which we are operating it. So they have not suggested that we're doing anything like, for example, with the Penfield, where it was a they didn't build it to the standard that FEMA required. Right now, to my best of my knowledge, we're doing everything that everyone else is doing, submitting things that are required around this pandemic.
And Ms. First Selectwoman, you know, I appreciate that. My recollection was that there was a problem with the application. So the basis for my question is this. I don't want to be sitting here on June 30th or July 30th or whatever, and somebody saying, oh, you forgot to fill out the paper the right way. I was just curious if we hired a person. It sounds like the answer is no. But I think we, you know, and let's hope the federal government is going to do just a stellar job on this, as opposed to Superstorm Sandy. But I think we have to start thinking about what we're going to do with that number that's going to be north of $500,000 by the time we hit June. If we don't get that money, I think we need to just start considering that.
No, I understand, and I understand that concern. Although I have to say, I was pretty impressed with the government's reaction in getting those most of the money that they got out to businesses. I know a lot of people are still waiting, but there was, you know, if you just look at the data, the way they got that money out, I know there was a lot of businesses owners who didn't get it, but there were a huge amount that got it really quickly, which is pretty unprecedented. So listen, I don't know what's going to happen, but we're following the guidelines the way they've established them. And I know with Penfield, they didn't follow those guidelines. So that's a little different. You know, they didn't go with the FEMA guideline as far as building and stuff. Let's hope.
Yeah, I'm praying. Yeah, I'm not so sure that's true, but I'll leave it at that. So thank you, Chairman.
Let me just go in order here. I'll go to Ms. Charlton, and then she had a hand up first, and then to Mr. Walsh. But Ms. Kupchak, sure we have at least an attorney that would look at these applications, right? That's familiar with this?
You know, I don't, Jim, would you, Attorney Baldwin, can you weigh in? I mean, I don't know that, do we typically do that? Do you look at these?
Yeah, well, there's a huge volume. This is Town Attorney Jim Baldwin. There's a huge volume that gives direction as to how to do these applications to FEMA. It's very involved naturally, and I have reviewed it, and it's my understanding that the town is following those guidelines. So it's in process, as I understand it. But I'm not leading that process. I think that the fire and police in particular are very much involved in that because they're so involved in what's going on. But yeah, it's in progress.
All right, thank you, Mr. Baldwin. Sorry, Ms. Charlton. Go ahead.
Oh, that's okay. Just a question on the legal. Are we inputting this at the actual rate that's paid? Because I mean, 55,000 comes out to, I don't know, something like 275 hours at $200 an hour, which is like, I don't know, 6 or 7 man weeks of time. That can't all be for interpreting executive orders. So what is there a higher rate being used, or what else is does that represent?
That's a good question. I am trying to capture every moment of my time associated with anything having to do with COVID. And that would include, consider it, all the special meetings that have been made necessary, all the advice about FOI, formalities that now need to be changed in order to comply with our meetings. And I've had numerous, a huge number of meetings with various boards and commissions as to how to conduct their meetings. And I am taking the liberty, and I think it's appropriate to do so, to include that time expended in the COVID-related expenses, if you will. So that's a huge part of it. Just think about the tax deferral program in and of itself was a large amount of my time, and others, not just me, but others. And so I'm very particular about it, and I am trying my best to capture every moment to cover that. It comes to around, I think the average has been close to $10,000 for the last 2 months. And I think if you extrapolate that to the end of the fiscal year, it comes to somewhere close to that $55,000.
Okay, thank you for that. So this goes well beyond just interpreting executive orders. This is implementation and dealing with management and all the town bodies that are executing the details of all these orders. So it sounds like close to a full-time, endeavor here. All right, that makes more sense. That was my question. I was just going to say to, Brenda is not here. I was just going to say, oh, she's back. I was going to say on your comments, Ms. Kupchak, on the payroll protection program, I think the federal government probably got that money out quickly because it was, facilitated through banks that had previous relationships with the SBA. I wouldn't count on that kind of efficiency for FEMA payments. We'll see.
I'm hopeful, That's
yeah.
all. I'm just trying to be hopeful, Lori.
I got you. Thank you.
Okay.
Yeah. I would agree. I wouldn't hold our breath on a FEMA payment. Mr. Walsh.
First, Mrs. Kupchak, you said that, this is the first time I'm hearing it, that we didn't follow the proper procedures in regards to our filings in regards to the Penfield Pavilion FEMA reimbursement.
No.
I'm sorry, I said what I thought was, my understanding was from what I've read is that we didn't follow, or the reason it was held up is because maybe it wasn't built the way it was FEMA wanted it, or it wasn't built a specific height or something like that. That was my understanding.
Okay.
And
I read our
appealed, and the town appealed because they said FEMA wanted it a certain height, the town built it a different height, or.
No, because I read the town's appeal, and I thought we put forth a pretty forceful argument on how we did meet all the requirements. So that was going to be some news to me. In regards to capturing time, Attorney Baldwin, you made some good points about collecting, trying to capture all your time. There's no time down for information technology who's been running all of these meetings and stuff like that. Is that capturable time? To do all these meetings that Mr. Baldwin talked about that he arranged and all that stuff?
Is that a question to me, Jim?
I don't know. Whoever from the administration can answer. You, Jim, you put together a pretty forceful argument why that's capturable time, because you had to do this because of COVID. Well, our IT director, who I think he might be on the host here, has been on all of these meetings, all these town meetings and whatever. I presume he's putting in extra time going to some of our meetings go till midnight or after. Or I'm sure there's other IT staff, but I don't see any numbers listed for IT.
Is that, Caitlin, is that because Dave is a department head and he doesn't get overtime? Caitlin?
Well, there is a, there is $2,400 with the, under the supply column for them,
Yeah.
as you can see. Possibly, I mean, I could ask Dave Kelly because I didn't prepare this sheet, but maybe he's taking the regular time as comp time.
Maybe.
Comp time? Can we find that
Well,
out?
I'm saying
I
that
mean,
he's
comp
working now.
comp time should be listed as here as a collectible cost.
No,
I'm not sure.
saying
You'd have to ask Dave Kelly, but I know that Jim spent quite a bit of time because I was in those meetings when we were trying to set up WebEx, to make sure it was in compliance with FOI, and then the executive orders about not allowing the public to comment, and then does it work? And I mean, actually, believe it or not, I know it sounds not that complicated, but there was a lot of long meetings talking about it. But I guess Kelly could probably, if you shoot him an email, and then he could share it with the Board of Finance to give you more details on that.
So if I may just jump in quickly, Mr. Walsh, I think Mr. Mottola has an answer to this. Mr. Mottola, or at least a comment.
IT director is not entitled to overtime under the law. He's a department head. He's under the Fair Labor Standards Act, he is a non-exempt employee. So can I say non-exempt? He's not entitled to overtime. He's a professional, and so he wouldn't be able to get those things.
What about
that's probably why you don't see any overtime there.
What about his regular pay that we have in the regular pay line?
I don't know, but I thought on the regular pay line we weren't getting reimbursed for that anyway, right, Caitlin?
Correct.
So then why are we listing police costs on regular pay? We don't need a regular pay line. We're not getting reimbursed on it.
Well, again, if anyone wants to know our total COVID costs, and I can follow up with Mr. Kelly, but possibly he's working 5 hours tonight to do this meeting, but maybe he didn't work 5 hours during the day today.
Yeah, if we could find that out. And then town planning and zoning, they've been doing a lot of stuff for this COVID about trying to get our restaurants open over the last week. And they're going to be continuing to do work and doing inspections and going out to places. And so is the fire department, and so is the health department on all of this and trying to get some of these restaurants and stuff open. Are those costs being captured?
I mean, which department are you talking about? Just across the board?
Well, yeah. So building, health, and town planning and zoning have been spending an inordinate amount of time trying to get these restaurants open, all because of COVID.
Mm-hmm.
Is there any overtime or regular pay being spent by them and their departments on doing that? Because I thought it was an entire department project.
Well, mostly the department heads, we have a task force that's set up that we meet and do all this work for the last couple of weeks, maybe because it's only been the last couple of weeks that we've been working on it and reaching out. So I'm not sure if there's this regular non-department heads. I know that they're going out, and Jim Went's been out quite a bit, and Tom Conley and Sands, and Mark Barnhart's been, obviously, we've been all interacting with the businesses. I don't know, Caitlin, do we have anything submitted by any of those guys so far for the last couple of weeks?
These numbers come from them, so I would have to ask them why they haven't submitted it.
Okay.
Caitlin, does any department head get comp time? Does that exist for department heads, or is that just illegal to have?
I do not believe they get comp time.
I would believe they're exempt employees. They don't get overtime. They don't get anything. They get their salary.
Okay.
And whatever.
Okay. In regard to these numbers, a lot of these numbers are new from April 15th, and I understand the actual numbers as we get through today, but these are also projected to go to June 30th, and I think it's the reason why we're seeing dramatic increases across the board to take it from the $170,000 that Mr. Brown reported to $659,000. Can we have the department heads kind of tell us what the projection is, and also some of what these supplies and other purchases are? Because some of the supplies are in the $40,000 range. But can you go to the department heads? I know that they went back when we asked this the last time and were able to tell us up to April 15th.
Sure.
Okay. And then what, Ms. Kupchak, the emergency management team, you mentioned that you guys were meeting every day. Is that still going on every day?
Sorry, getting some more water. Not every day, but frequently. And then the business task force, that is separate from the emergency management.
Okay. When did the emergency management team stop meeting every day?
Oh, I don't remember, actually. I'd have to look back. But we meet during the week. Well, then we have command meetings with the department heads, and so we meet, and then we met with the department heads when we shut the building down, and then we had to reopen the building and how we were planning that. Now, in addition to the emergency command meetings, we're also meeting to fully reopen town government with everybody coming back right after Memorial Day. So there's a lot of planning in that, because there's going to be more people in the building. And just some of those costs you were speaking about, Mr. Walsh, earlier, is gloves, PPE for people in the building, spraying door handles, wiping down things of that nature. There's a lot of that going on.
Okay.
But I don't know the answer to that, because it's so many different meetings.
Who's doing the spraying down of the handles and all that stuff?
Well, we have DPW doing that regularly during the day, especially in the departments where there's people like town clerks, where there's people coming in and out the counters and all of that. Now, building and zoning will have the ability for people to come in too for appointments, but they're still going to be dropping off stuff. But then we have a company, they come in and spray 3 times a week. In the morning, spray with this, I don't know what it's called, a static or something. They spray everything with like this virus killer or virus killer.
Okay. Yeah, if we could just get those numbers on how these projections were created, so it might just give us a better understanding of why this number got up almost $500,000 more than we were last presented with by April 15th. And Mr. Chairman, I'm making a request that we cover this every meeting until this is over, so we get a handle on this, because these numbers can fluctuate drastically, especially if we don't get the reimbursement.
Okay, noted.
Thanks.
Thank you, Mr. Walsh. Mr. Baldwin, you had a quick comment?
Yes, just a quick comment about the Penfield reimbursement in particular, as it concerns FEMA reimbursement. I just want to remind the board that there was an issue concerning that reimbursement, which is directly associated with the bill file and the foundation. That is in part, as I understand it, one of the reasons why we did not get it.
Mr. DeWitt?
Thank you, Mr. Chairman. So, Chris DeWitt, I just want to be clear about my question. My question was, it was a big deal to hire a consultant to do FEMA reimbursement paperwork back in whatever year Sandy was. Now we're doing the exact same thing, less numbers. And the question was, have we hired anyone? And I guess the answer is no. So I get it. There's other things that may have complicated the reimbursement of Penfield, the elevation and all these things. My original question, based on, did we hire anyone? And the answer is no. So I get it. Thank you.
Okay, thank you, Mr. DeWitt. Anything else, Mr. Baldwin, on that subject?
No, I just wanted to add that point.
All right, thank you. Mr. Walsh.
Mr. Brown, at a future meeting at your convenience, can we get an update on where we stand? It's been a while since we've done an update. I don't want to drag it out tonight. can we get a full update on where we stand with the process?
I'm sorry, with the what, Jim?
The reimbursement on the Penfield.
Yeah.
Can I just jump in, Mr. Brown? Right now, there is no update to give because we had filed the appeal and then we were waiting for an answer and pandemic hit. So I actually just checked with Jim Went the other day. There's no movement coming because I think they're just not processing anything or even looking at it. And we have engaged our federal delegation early on when I first came in on this appeal to make sure they were looking into it on our behalf, but there literally is nothing to offer because it still stands the way it was. We're just waiting for the federal government to respond. And they're not right now because their hands are tied with this other stuff.
Okay, thank you, Ms. Kubchak, but we can still certainly ask the question, and Ms. Bassi, if you could just come prepared for any updates.
Okay.
Thank you. Okay, Caitlin, back to you on any of these documents. Anything else you'd like to point out?
No, that's about it.
Okay, to the board, are there any questions on the document that Ms. Bassi has reviewed with us, or or any questions, comments on the variance reports, which basically leads to the operational variance? Mr. Walsh?
On the expenses, the personnel savings seem to have increased, correct, by like $35,000, approximately maybe $34,000. What was the reason for that?
Well, there was a chance that as of Q2 that some of those positions were going to be filled and they haven't been.
Okay. And we don't expect them to be filled before the end of Q4?
I'm projecting that to be the vacancy variance for the end of June, so the 715.
So they're not going to, no one's going to fill any of these variances before. Correct?
As far as I know, yes. I mean, that's the 715 is where
Okay, that's where you're estimating to go. Okay. All right. So now the final estimated increase in fund balance, $1,541,000.
if you're adding on the state revenue to that?
You told me the reason the way I got to that was to take $1,316,000 and add on 275, and it's just a number I did in my head, which could be wrong. So let me just add it up on a calculator. It's actually $1,591,000.
Okay, and if we're doing a range, if you want to take out the FEMA, so you can take that out too if you want. So then we're down to taking out
But you're telling us not to take out FEMA because you feel pretty confident that we're going to get it?
Well, I'm hoping, and we'll know more at the end of see how this first quarter reimbursement goes.
And when do you expect to get that?
I have no idea, but we have some time. So now we're in May, and normally we close the books September, October, and we'll see if we have any feedback by then.
How long does it normally take once you make a report?
I'm going to also, not to interrupt, talk to my auditor because he's now auditing this for every municipality. I'm sure we're all in the same boat. So I ran this process by him the other day saying, okay, here's what I think, and I'm going to approve this receivable. And he was on board with that. So we'll see what his thoughts are as well, because clearly we're not unique in this situation.
Is the reimbursement up to 75%, or does it clearly say 75% that we should get?
I believe it's 75. I can go back and look at the paperwork. And I'll ask my staffer who was in all these meetings and who's been trained on the grants portal and to see if she has anything else.
were we advised how long the process takes from the time you do a filing to when we should receive money into our account? Is it normally like 3-month period of time or a month or?
We were only advised to file quarterly, which is what we just did. I do not believe she's received any further timelines on when she gets the reimbursement.
Okay, when you did the last FEMA reimbursement we received on Storm Sandy, when you did quarterly reports, how long did it take to get the funds?
I do not believe we did quarterly. We had an outside consultant do it, so I can't speak to the exact time. That outside consultant, the firm is the one who actually filed.
Oh, the experts, that firm we hired from Louisiana?
Yep.
Okay. Okay. That's all I have, Mr. Chairman.
Anything else, Mr. Walsh?
That's it, Mr. Chairman. Thank you.
All right, thank you. Ms. Charlton.
Thank you, Mr. Chairman. Caitlin, just one point of clarification. The personnel savings of $715, how much of that is vacancy versus the furloughs?
Oh, the furloughs are not, that's full-time savings, the $715?
Yeah.
The part-time furloughs is in the other number. So there was like that 500 or so savings for the part-timers that was reported a while back. We also, which was then offset by operational. So that 15 is actually a net of COVID savings for part-timers and operational. In this case, a lot of it is unfavorable for the compactors and the same issues that we've been talking about. There's no new operational variances. It was just the part-time savings.
Okay, got it. So the 715 is all full-time. So the furloughs, what was the gross amount that's included in the 15?
It was about 500 for the part-timers. And then you have the unemployment costs, which kind of complicate things because we don't know when and if they're going to file. So that would be the 60%, but then there's possible 50% reimbursement of that.
But that's in the COVID number, right? So I'm just trying to...
The COVID number is the expense piece. The COVID is really expensive, right? And the unemployment is an expense associated with the COVID.
Okay.
So the furloughs have a savings and an expense.
Okay, so the furlough was roughly 500 of savings, which is part of the 15. And then we've got unemployment expenses offsetting that. And then what else is offsetting that?
Well, the whole COVID of the unemployment, right? The 180s and the 294 on the sheet.
I'm sorry, I'm just trying to get to what the pieces that are within the 15. Because I know
Okay.
the furlough piece, which is a big savings, but I'm just trying to wrap my head around what's offsetting that.
So the operational piece, which are on all of the expense piece, the biggest is the compactors and the overtime issue with Enviro, that -400 that we've been talking about for a while.
Got it, okay.
Besides that, there's a lot of ins and outs with some warm weather savings and some other smaller unfavorable, but they all net to about the 15.
Gotcha. Okay, I forgot about that. So that was the big piece that's offsetting that savings is that one. All right. Got it. Thank you very much.
You're welcome.
Thank you, Ms. Charlton. Any further questions? Okay. I just have one quick question. I'm not sure what we're talking about. These types of revenues and expenses and audits, it just came to me about the fill pile audit. Have we moved on that? Has that moved forward?
Yes, I believe there's going to be a draft on the June 4th. I believe there's an audit subcommittee meeting, but Mary could speak to that.
Am I unmuted?
You're unmuted, Mary.
Okay, thanks. Well, I haven't heard back from our auditor yet, but I did I do have a audit committee meeting scheduled for June 4th before the Board of Finance meeting. And I did tell him that we were hoping to have the report in advance of that meeting so we could review the report. But I also had asked our internal auditor, Connie Melfi, to help him finish up his interviews. He was having scheduling problems because not all the employees were in, so she was assisting in that process so he could finish his report.
All right, thank you. Thank you, Mr. Claire. Any further questions? So after June 4th, I don't know if we meet in July or August at all. Believe it or not, we'll have maybe 2 full months unless we have a special meeting and something comes up. But we do have that capital meeting, and I just want to throw this out there in September. And so we'll look at our waterfall, we'll look at our capital projects. And at that meeting, Ms. Bossi, if you could ask the department heads, if we can have just new capital plans for trucks, vehicles, paving. So as we go through it and we start to look at what we may be bonding or purchasing or what have you, if they could just let us know what their thoughts are and what their plans are for their fleet, equipment, paving. Gives you a 3-month head start.
Okay.
All right, thank you. Okay, so moving on to the next item. Item number 6, to hear, consider, and approve the following meeting minutes: April 9th, 2020, April 15th, April 16th, April 21st, April 23rd, and we had 2 for April 29th. So can I have a motion to put this before us? Mr. DeWitt, seconded by Mr. Testani. Let's start with April 9th. This is a Board of Finance budget hearing, meeting minutes for April 9th. All those in favor?
Aye.
Opposed? It's unanimous. Minutes for April 15th. All those in favor?
Aye.
Aye. Opposed? Unanimous. April 16th. All those in favor?
Aye.
Opposed? It's unanimous. In favor. April 21st. All those in favor?
Aye.
Unanimous approval. April 23rd. All those in favor?
Aye.
April 29th, the 7 p.m. meeting. All those in favor?
Aye.
And then the April 29th, 8:55 p.m. meeting. All those in favor?
Aye.
Okay, it is unanimous. Okay, so that carries. So item number 7. Here, consider and act upon any communications. Caitlin, do you have any for us? That is a no, correct? You were on mute.
No.
Okay. Item number 8, motion to adjourn. Ms. Charlton, very enthusiastically seconded by Mr. Mottola. All those in favor? Say aye. It is unanimous. Thank you, everybody. Have a great night.
It's not even 11, Jim.
See you in a couple of weeks. Okay. Thank you.